Hello, everybody, and welcome back to a new episode of ClueCon Weekly. I am your host, John Gray, filling in for the Italian Eagle Luca Pradovera. And today we welcome back Ian Richardson, co-founder of Fox & Crow Group, and was recently on the podcast. I'm excited to add on to what he had before. Ian, welcome back.
Hey, thanks for having me, John. Excited to be here.
Awesome. And for those who missed the last episode, if you could just give us a quick overview of your background, what Fox and Crow Group does, and some of the things you're passionate about.
Yeah. Thanks again for having me back on. As you mentioned, I'm co-founder and partner at Fox and Crow. Before starting Fox and Crow, I owned and operated a managed IT services provider in the Mid-Michigan region. It's right there if you navigate by hand-based geography, like all of us do. And ran that company for about 16 years, sold it at the end of 21. I like to say I was probably about a year and a half past my sell by date. So I'd kind of fallen out of love with that business over pandemic, and recalibrated and exited that company, transitioned out of there, helped my wife sell her call center, which she had had for about 10 years. And we both dove into Fox and Crow. And Fox and Crow is a management consultancy that's focused on the tech space. And we exist to just help those entrepreneur-led organizations scale their business and sell it when they're ready.
Nice. Yeah, obviously a lot of them, and they need your help, especially right now. As you mentioned, a lot of this kind of bursted after pandemic, and we see a lot of just shakeups in the tech space. Companies are left astray with a lot of different things. Ultimately, what everything boils down to are finances and money. Money talks better than everything else. So, I just wondered if you had any perspectives on just the importance of finance, financial planning, and what companies are doing, or some ways that you can kind of add value to that.
Yeah, it really, finances have become a major passion in my world, and it really stems from that ability to exit. So everyone has some sort of exit strategy for their business, even if it's not mapped out, because we all have to exit our business. You're either
Hmm.
walking out on two or carried out by six, but you're gonna exit your company at some day in some way, shape, or form. And getting that exit strategy at its crux is built off of finance. It's built off of having revenue coming in the door through a sales engine. It's built off of effective financial management so that the business isn't just a job
Hmm.
for whoever owns it. So just because we might want to work every waking moment in our company because it's a point of passion and it brings us great fulfillment, anyone who buys a business is buying that business primarily as a financial vehicle for return. They're expecting it to outperform the market, or else they just take the capital that they were going to spend on the company and dump it into the S&P. They
Hmm.
want that financial return primarily above everything else. And we have to keep that as entrepreneurs and leaders in companies. We have to keep that in mind, that unless the numbers tell a story of that financial return, no one will buy that company for what we want to sell it for. So you can always liquidate and fire sale, but that's pennies on the dollar. So
Hmm.
getting that plan in around effective return, effective expense and cost of goods sold management, being able to tell that story and build up equity in the company on the balance sheet is critical for any business who wants to have that successful exit strategy, that pot of gold at the end of the rainbow.
Hmm. So what are like some metrics or some ways that people can tell that story? You're saying, even from a business owner looking to find out the status of where he's at, or someone looking in, even just
Mhm.
like maybe internally, some of the employees or things that they're able to do in order to show, the larger picture to some of the big wigs.
Yeah. So there's a lot of there's a smattering of key metrics everywhere, but some of the most effective ones. I'm a sales junkie. One of my
Mm-hmm.
passion points is sales in an organization. So if I'm looking at a company and it's in a growth mode, a lot of the folks I talk with are software startups. So in the SaaS space, you're almost always doing cash burn. So you've got this big, unless you're bootstrapping it out of your own funds, but
Mm-hmm.
in some way, shape, or form, there's a pile of dollars we're spending down. Then we go get another pile of dollars, spend it down through series of funding, and that those series might come from you and your friends and family, but a lot of the times outside investors.
Yeah.
So that cash burn rate is a key metric, which cash spent versus cash received.
Mm-hmm.
Any sort of free floating cash flow that's tracked, as well as overdues when it comes to customer billings. Those are two key ones that I'm looking at. And at the end of the day, cash reserves in number of days is a key area if we haven't switched to a profitability model. If we've switched to a profitability model, I'm looking at margin percentage based off of product or service line. I'm looking at that bottom line income. So I'm going to look at both net income and EBITDA to try to take out the accounting shenanigans that
Mm-hmm.
occurs. I'm going to be looking at current ratio on the balance sheet to see how materially healthy the company is, because profit and loss is just that snapshot over the year. So balance sheet showing that true preservation. And then things like gain on investment or gain on assets. So ROI, ROA, revenue growth is a
Mm-hmm.
big one. Customer acquisition cost is a big one, as well as customer lifetime value. So that's CAC and CLV if you're a big acronym junkie. Just how much does it cost for us to get a new customer, and how much money are we going to expect to make over the average lifespan of that customer?
Yeah.
Those are key ones. And then some non-financial metrics, ESAT and employee turnover. So
Huge.
how happy are the employees, and how often are they turning over? Because if there's something going on over there, all of those financial figures, every single one that I mentioned, are going to have holes blown in the side of them.
Mm-hmm.
So
Yeah, that's
those
really
are,
interesting
yeah,
to mention just company turnover as a metric that isn't directly related, but a lurking variable in some of those calculations. When
it is because like you have to go out and hire someone. Well, what's the staffing agency cost? What's the cost of onboarding? What
hmm
happens? What's the productivity dip on the buddy ups that you have? Because they're going to have some sort of HR person who's kind of sherping them through the first couple of days, but then they get handed off to the team lead or the team trainer or the senior resource on whatever team they're at, and that person's productivity is going to take a hit because they're
hmm
explaining everything as they go through. They're, depending on how well documentation and training is, that shadowing period might be quite long in terms of tail length.
Oh,
So
definitely. Yeah, and the timeline of those is so incredibly important. Just talking about personal experience at SignalWire, I was lucky enough to join when we were relatively small, and to see those pains of growing a little bit, and when you're like, okay, we need more people. Well, by the time you realize that you need more people, it's already too late. Because then whoever you have working is now having to work, double time, even though they were already screaming for help, and now they're training someone. So that timeline was incredibly important, and something I didn't really understand until I witnessed it firsthand. On some things, and so everything can kind of mellow out, and the boat isn't too rocky anymore. Um,
yeah,
but
leading versus lagging indicator on when to hire is hard. I think
oh yeah,
anyone who gets that really nailed down in a way that just works, they're the next trillionaire on the planet,
hmm
right? Like
definitely,
everybody struggles from that one.
yeah. And you were mentioning just some ratios and some of those quantifiable variables. I'm curious how different the different companies are. Although we're all in tech,
Hmm.
we don't have a lot of like capital. We're not sitting on, 100,000 Amazon warehouses of product. But do you
Hmm.
notice that companies are a lot of times different, or when you're looking at a kind of big picture, are they all like fairly similar and cookie cutter?
Yeah, There's significant differences depending on the primary business model. So a big portion of the companies we work with are service providers. In a services based business, there's not, at first glance, when you look at the balance sheet, especially, there's just not much to it. There's not a huge amount of assets. So they might have a, $500,000 in cash if they're a well capitalized service provider, 500,000, maybe $1 million in cash, maybe some long term hold investments if the leadership team isn't sweeping cash out of the company,
Mm-hmm.
or some short term investments if they're looking to grow non organically. They may have some funds or things like that sitting around ready for cash deployment. But outside of that, there's not much to them. They'll have some desks and some laptops, maybe a fleet of vehicles, maybe
Yeah.
these days. If there is a building owned, usually that's in a holding LLC, so it's not actually on the books. They're almost always playing the tax game of sweeping rent to themselves
Yeah.
if they're in real estate. And that's about it. So there isn't inventory, there isn't product, there isn't intellectual property, even like there is with a software company.
Mm-hmm.
So I'm really, really heavily looking at profitability. You're looking at where's gross margin at, and if they're classifying billable payroll above the line as a cost of goods sold because they're selling service, that's where it belongs. You're looking for that 50+% margin, because otherwise they don't have 30 points to pay that SG&A. They don't have that 30% that it's going to take to run a good executive team, to pay sales and marketing out well, and to fund sales and marketing plus whatever general operating expenses are needed, because most of the cost is in the payroll of delivering service.
Oh yeah.
Um, Likewise, if I'm talking to a VAR or a reseller, that's going to shift. The cost of goods sold is mainly going to be those products. There is going to be some inventory on there. There are going to be some assets. The margins are going to shift around. And a really well running VAR might be in 10% profitability, but because they're pushing 50 million in product, it's still dropping quite a big chunk of change down to the bottom. And a
Mm-hmm.
single digit profitability isn't such an alarm bell as it would be in a service provider company. A service provider, if you're at 10%, you're almost at break even, because all it takes is one account or two accounts, or needing to do an unfunded hire or having a turnover event, and that profit evaporates very quickly. You have to run at 20% to be able to take the plan getting punched in the nose, or punched in
Yeah.
the mouth, as Mike Tyson would say.
Mm-hmm.
Um, so it just depends. It depends on variability. And then, like I alluded to before, if you're more in the software, the SaaS space, if you're building applications, it's a whole different run rate. Most SaaS apps, especially in the startup phase before they're getting acquired, they're actively trying to spend the money. They don't want to show a profit on taxes. There is no tax payment. They're always running in the red as a strategy. It's how do we deploy this funds as rapidly as possible to both build out the product and acquire customers at a rapid basis, because the founder or founders know that the eventual goal is to get acquired by someone. And
Mm-hmm.
that's when profitability becomes the concern, is they need to be able to paint a picture on the model, but they don't even have to execute on that model to get acquired these days in that space. It's just, hey, we got this pile of 1,000, 2,000, 5,000, whatever it is, customers paying us at X dollars. And if you plug this into an existing sales organization and fund it, it'll deliver this much cash flow and this much competitive advantage to your software suite.
Mm-hmm.
So,
No, that's definitely really interesting, and I didn't even think about the strictly software as a service versus reseller, but so much of the resources is actually creating the product. And
that's
at
right.
first I thought, oh, a tech company, like the big all you have to do is make an app, but it really is so much more of explaining to people the importance of why they need that, and then kind of
Hmm.
rolling that out through sales. I'll just quick side note, a lot of the stories you're telling me reminds me of Silicon Valley, and just like a lot of those startups, as they are like, you silly gooses, like you don't understand that this is like the greatest product of all time, but that isn't explained too much in worth to the end user, the customer, the person that they're trying to have. So you mentioned a lot of your passion with sales and kind of that rollout, but I'm just curious how this is maybe a very loaded question, but how some of those metrics that you used, tell a story, but then how are you able to kind of roll that out into a sales implementation, especially with the focus being in tech, where it's not just, oh, I can put this on a shelf at the supermarket and people will buy it, but how
Mhm.
are you able to kind of translate that story to sales in order to see some of those metrics kind of change for just
Yeah.
ultimate growth of the company? Very
Yeah,
loaded question.
so it every number can tell a story. So that's the cool thing about data is that it can tell a story, but
Hmm.
you also recognizing and harkening back to our previous conversation, if you put, 100 people in a room and give them a set of data without any sort of extra interpretation, and all things being equal, chances are the interpretation that you and I have may be shared by about 20 to 30% of that room, and the rest
Hmm.
of the room is going to have multiple different interpretations. And that stems from our personality, our background, our skill set, etc. So four people can look at the same pile of data and come to four independent conclusions and interpretations of that data. So you can't just give data off to someone. You can't just give metrics to someone or ask metrics of someone in a sales conversation. You have to have that story, that narrative in mind. And so it's easier with an example. And one of the big things we do is we have a productized sales offering. So how to sell, how to build an organization, etc. And if I'm approaching someone around that product suite, I would say, hey, talk to me about your historical growth. So I'm going to immediately shift the conversation onto the prospect. How have you grown to date? What's that looked like? How many conversations do you have to have? How long is the sales cycle? What's that customer worth? How long does that customer stay on board? And eventually, because I know that they're a qualified prospect, I'm going to switch to the pain. So when did that change? When did referrals, usually the issue, become not enough? Well, tell me about that. What have we tried to date? And I'm starting to paint the picture of how much money it costs to acquire a customer. So I've already established customer lifetime value. They say, oh yeah, someone might stay on for 5 years and pay us $5,000 a month. Great. Well, that's 60,000 times five, $300,000 customer lifetime value. That's a key
Hmm.
data point. What's the profit you get off of that customer is a nice one, so that they can say, well,
Oh
all
yeah.
things being equal, here, we'll make 20 cents on the dollar there. So that's the real money down at the bottom that I know about. And then having that conversation on, well, what have you been spending? What are you spending to acquire new customers? What if I could lower that? Then becomes the talk track. So if they're saying, hey, we're spending on average $15,000 to acquire a customer, or 20,000 or $25,000 to acquire a customer, what if I could cut that in half? Is that a worthwhile thing? Is that worth some investment? How many
Uh-huh.
new customers do you want to get this year? Oh, well, we want to get 20. Well, if I can take $12,500 times 20, which is whatever the math is on that, I'm not going to do it online. If I could take that money and put it back into your pocket, would you be able to redeploy that to get 30 customers or do something else? Is it a more like what would the strategic gain being off of having that dollar amount?
Hmm.
And now I've painted a picture of here's this pain point that you weren't necessarily aware of through conversation and a potential gain that you didn't know existed from this product or this service. Monetize the pain, monetize the gain, paint the picture on how you help them get there. And now I've got demand.
Hmm.
That's assuming someone doesn't know about the product. If they already know they have a problem, much easier conversation. Well,
Oh
hey,
yeah.
like you're saying your customer acquisition cost is out of control. I can reduce that by 50%. for $6,000 a year. How do you do that? And then I start the conversation.
Yeah.
So those numbers can paint a picture and tell a story. You just have to know how to use them.
Definitely. I like the quick little monetize the pain, monetize the gain. I need to get that on the t-shirt. Fox
Pain
Pro.
plus gain. That's the sales magic.
Uh-huh.
So the funny thing is, so there's about 7 common objections in a service-based sale, and everyone's favorite one is you cost too much. Someone saying you cost too much is directly correlated to you not monetizing pain and gain. It's a 1-to-1 ratio. You didn't show enough ROI.
Mm-hmm.
So in that previous example where someone wants to acquire 20 customers at $25,000 a pop, if I'm able to save them over $200,000 on customer acquisition cost for a $6,000 annual investment, even if I perform at 50 or 25% of my promise, they're still making out like a bandit. And an entrepreneur or a financial leader will do that math and say, yeah, this is a no-brainer.
Yeah.
Like spend the cash, even if it's 10%, we're still coming out ahead. And that's a real key thing, is a 5 to 10x return on an offer, a 5 to 10x value prop makes it so compelling of a financial investment. You blow it doesn't matter where the figure's at. As long as it's that much, someone will fund it if they have the ability to fund it.
Definitely. And yeah, that brings up just a point that I wasn't even really thinking about, a lot of both on the customer selling the, tech product, as well as, a company buying, you as a product, and getting a lot of
Mhm.
that investment as well, where both have a story of, how things can look in the future, live how much better your life will be with my application in it, or, look at what the future could hold, if you were able to get these metrics in kind of the way that you wanted them to. And
And what's cool about people is they'll tell you it.
yeah.
Hey, John, if you had that extra $200,000, what would you spend it on?
Hmm.
And let them paint that picture. And then when you come back to give them a proposal, you just repeat back what they said. Hey,
Yeah.
and we'll be able to free up to that $200,000, which will allow you to go do ABC. And then you've taken them right back to that position. They're knee deep in the pain. They're knee deep in that hopes and dreams area. And
Hmm.
humans are irrational, emotional buying critters. So you're taking numbers and data to create feelings.
Definitely.
And the CFO, who is going to be the unemotional one in the room, who's looking at those numbers, will say, "Yeah, it's a 10x return. What are you talking to me about? Go ahead and spend the money. It's a good bet."
Yeah. Exactly. And to kind of bring this a little bit more to surface level, I'm just curious if you could talk through either a great company success or a great company failure, like horror story, and then maybe just like how people can get involved with Fox and Crow Group in order
Yeah,
to have them help their business.
yeah. I'll do both. I'll do both.
Nice.
So I'm gonna start with the bad news first.
Hmm.
And I don't have to change the names on this one because this is my own story. So back at my IT company, we had a long tail impact from COVID, and that long tail impact was throughout the course of the pandemic. People kind of hunkered down and they started having conversations. So that triggered a lot of entrepreneurs that we were working with to start having M&A conversations. And at the end of COVID, what happened to occur is that those conversations all accelerated all at once. The capital started to get deployed, and we went through a churn cycle of 30% of gross revenue, all non caused by service issues. So we just had multiple customers get acquired, acquire other businesses, get acquired by private equity, and so on and so forth over the period of 6 months. So it was a iceberg size hole in the side of my Titanic coasting along. And it
Uh-huh.
was a really, really big problem to overcome because you lose 1 or 2 accounts. Hey, not a problem. You speed up the sales engine. Maybe you have to offer a slight discount to get in some revenue in the door, but you can patch that hole. But if it's hit after hit after hit after hit, it really can cause a problem. And I had promised up front to my team, hey, we're gonna run this thing till the wheels come off. Like absolutely the last thing that would happen, if needed, would be a layoff or a downsize.
Hmm.
And about 18 months later, we had to have that conversation and lay some people off because the revenue wasn't there to justify it. It was a very long sales cycle business. It took a long time to get people in, and one of the things we had to chop early on was our lead generation engines because fundability wasn't there. So we
Yeah.
didn't have the money to keep investing into that, which perpetuated the problem. So that's what can happen, like financial wise, and not seeing the signs early on can happen. And it would have been better to trim payroll a bit earlier, as well as probably have conversations with the team on like, hey, let's drop some people down to part-time or things like that, which could create the pressure point where people might self-select out
Yeah.
over time versus waiting until it became more dire and we had to use a big hatchet. On the positive side, we just had this conversation with an entrepreneurial couple over the course of last year. Valuations can be dangerous. So the success story is getting a business valuation can be dangerous for you. So they had an accountant, certified valuator came in and did a certified valuation, said, "Hey, your company's worth X." And we had started working with them right after they had gotten this valuation. And so about 4 or 5 months in, there's this basis of trust built up in the relationship. And I said, like, yeah, let's talk about that. Let's talk about where your finances are at. You seem kind of burned out. You seem kind of worn down. And I said, like, how much do you need off of your company? How much do you need like net cash in your pocket at the end to be okay? Oh, well, we need this figure. I can get that for you tomorrow. Well, the valuation says X. The valuation is wrong.
Hmm.
Valuation came out at one figure, and the actual valuation to anyone who would buy this company, because they're all strategic buyers in the IT space, was 3 times the professional valuation. It wasn't off by a couple 100,000, it was off by millions.
Yeah.
And the total compensation to the owners is 2x what the valuation was because they rolled a significant portion over into equity of the acquirer, and they'll get paid out again in 5 years. So they're almost getting the same payout at close that they are in 5 years from now. So it's just a big, massive chunk of change. It's life changing money to them and their family.
Oh yeah.
So my caution that I would say is business evaluators only know what they can talk about. So getting a general business valuation or even a specialty valuation can be useful, but most of the time you can find people who are in the space who will say, look, it's not a professional valuation, but back in the napkin math based off your numbers, all things being equal, you'll be between X and Y. And most people who aren't in the business of selling valuations will give you that number for free.
Hmm.
So just take that sort of stuff with a grain of salt, I would say, is the success story. You don't have to
Yeah.
be handcuffed by what a sheet of paper tells you your company's worth.
Hmm. No, I mean, as you kind of mentioned before, all numbers kind of tell a story, and to be able to interpret them in the way that it matters is why we have the entire field of statistics.
That's right.
Numbers are so easily manipulated, and that's actually what I got my degree in. Though, like, it's a random weird thing, but you see it all the time where
Mhm.
a number can show one thing, but then you think about it a little bit longer, you look at things from a different picture. For that company in particular, it's a lot better to find out that your evaluation is 3x times what someone may have interpreted it to be. That's a lot better than like finding a $20 bill in your pocket. But it's almost the same thing where it's like, this is what I had before, this was my interpretation of what it was. But now looking at it in a new lens, or having
Mhm.
the vision to implement the potential of what that money could be, is obviously where all the value lies.
That's right. That's exactly right.
Hmm. Well, Ian, is there anything else you want to plug? Shout out any other stories or way that people can get in contact you at Fox and Crow Group?
Yeah, yeah, they can you can always find us over at our website foxcrowgroup.com. I'm super active on LinkedIn. It's my full name, Ian Alexander Richardson. So linkedin.com/in/that. That'll get you over to me. And if you're in the tech space and you're struggling with sales, check out mspsalesprocess.com. That's that productized offer I was talking to you about that can have your customer acquisition cost. So
Awesome. And everyone, be sure to check out the episode that we had previously with Ian. Talked a lot about communication, organization, structure of businesses, and the likes. But Ian, you're a wealth of knowledge. I really appreciate you sharing everything with us. It's been a great convo.
oh, hey, thanks for having me on again, John. I really appreciate the opportunity to come on and talk and share some passion points around numbers. I'm a numbers guy.
Definitely. Well, we'll catch you soon, Ian. Thank you.
Take care.